Building wealth for the long-term, investment strategies. Building wealth for the long term requires a thoughtful investment strategy that takes into account your financial goals, risk tolerance, and time horizon. Here are some investment strategies to consider. 1. Diversification. Diversification is a fundamental investment strategy that involves spreading your investments across different asset classes, industries, and regions. By diversifying, you reduce the risk of being overly exposed to the performance of a single investment. If one investment underperforms, the impact on your overall portfolio is minimized because other investments may be performing well. For example, during a market downturn, while stocks may decline, bonds or real estate investments may hold their value or even increase. Diversification helps smooth out the ups and downs of your portfolio, providing more stability over the long term. 2. Asset allocation. Asset allocation is the process of determining the appropriate mix of asset classes for your investment portfolio. It involves considering your financial goals, risk tolerance, and time horizon. Younger investors with a longer time horizon can generally afford to take on more risk and allocate a higher percentage of their portfolio to growth-oriented assets like stocks. On the other hand, older investors who are closer to retirement may prioritize income and capital preservation, allocating more to bonds and other lower-risk assets. Asset allocation is a dynamic process that should be periodically reviewed and adjusted as your circumstances change. 3. Buy and hold. The buy and hold strategy involves investing in quality assets and holding them for an extended period, typically years or even decades. It focuses on long-term wealth accumulation rather than short-term market timing. By adopting this approach, you allow your investments to benefit from compounding returns over time. While short-term market fluctuations can be unpredictable, historical data has shown that over longer periods, the stock market tends to appreciate. By staying invested and avoiding knee-jerk reactions to market volatility, you can capture the overall growth of the market and increase the probability of achieving your financial goals. 4. Dollar cost averaging. Dollar cost averaging is a disciplined investment strategy that involves investing a fixed amount of money at regular intervals, regardless of market conditions. When prices are high, your fixed investment amount buys fewer shares, and when prices are low, it buys more shares. This strategy removes the need to predict market movements and helps mitigate the impact of short-term market fluctuations. Over time, dollar cost averaging can lower the average cost per share, potentially improving long-term returns. It also instills a habit of consistent investing and removes the emotional element of making investment decisions based on short-term market movements. 5. Rebalancing. Rebalancing is the process of realigning your investment portfolio back to its original target asset allocation. Over time, the performance of different investments may cause your portfolio to deviate from your desired allocation. For example, if stocks have performed exceptionally well, they may become a larger percentage of your portfolio than intended. By rebalancing, you sell a portion of the outperforming asset, in this case, stocks, and reinvest the proceeds into underperforming assets, such as bonds or other asset classes. This practice helps maintain the desired risk and return characteristics of your portfolio and ensures that you don't become overly concentrated in a particular investment. 6. Long-term investing in stocks. Investing in individual stocks can be a rewarding strategy for long-term wealth building, but it also comes with risks. When investing in stocks, it's important to focus on quality companies with strong fundamentals, competitive advantages, and a track record of sustainable growth. Conduct thorough research, analyze financial statements, and consider factors such as the company's management team, industry trends, and competitive landscape. Diversify your stock portfolio across different sectors and market capitalizations to reduce risk. It's essential to have a long-term perspective, as short-term volatility is common in the stock market. By investing in fundamentally sound companies and staying invested over the long term, you increase the potential for capital appreciation and compounding returns. 7. Consider index funds and ETFs. Index funds and exchange-traded funds, ETFs, are investment vehicles that provide exposure to a broad market index or a specific segment of the market. These passively managed funds aim to replicate the performance of the underlying index rather than trying to outperform it. Index funds and ETFs offer instant diversification across a basket of stocks, bonds, or other assets. They typically have lower fees compared to actively managed funds, making them cost-effective for long-term investors. Consider investing in index funds or ETFs that align with your investment objectives and risk tolerance. They provide a simple and efficient way to gain exposure to various asset classes and can be held as core holdings in your portfolio. 8. Seek professional advice. If you're unsure about investing or lack the time and expertise to manage your investments, seeking professional advice from a qualified financial advisor can be beneficial. A financial advisor can help you define your financial goals, assess your risk tolerance, and develop an investment strategy that aligns with your objectives. They can provide personalized guidance, monitor your investments, and make adjustments as needed. A professional advisor can also help you navigate complex financial markets and provide valuable insights based on their experience and knowledge. However, it's important to choose a reputable advisor who acts in your best interest and clearly communicates their investment philosophy and fees. At last, also subscribe our channel.